So welcome, Jill. Welcome, Chris. So Jill is a host of Trade Talks. Jill covers the market stories that matter in one-on-one conversations. She knows everything that's relevant in the market that's going on today. So a pleasure to have you here today. Chris, with Wilkie Farr and Gallagher, everything that we need to know in legislation and what's going on in this world today. I know we have a lot to cover and you have limited time. So I'm going to let you start and then just go along and tell us a little bit about what's happening in the markets, how we need to be assessing and looking at what's going on in terms of legacy businesses, what's coming down the pike that we need to pay attention to. If you set the landscape for us there, Chris, then go into perhaps some of the legislations and some of the changes in the world of that environment. There is a challenge with Web 3.0, blockchain, and the financial industry that we're seeing, and give us an overview of what's happening there that we need to pay attention to.
Yeah, so Chris, it's great to have you here with us, and of course with your expertise in the regulatory space. I'm going to fire away some questions here, and I think it's interesting because I feel like we're at an inflection point right now where it's no longer us versus them, but getting the technology and the scale and marrying those two together. So with that said, let's talk about the latest news with CBDCs and the recent executive order.
Yeah, so 2 years ago when I left the CFTC, I did an op-ed in the Wall Street Journal. It had a great title. It was entitled, "If we can send a man to the moon, we can send the dollar into cyberspace." And really was an argument that the United States was lagging the rest of the world in examining a central bank digital currency. By then, China had announced their very ambitious plans, which now 2 years later have been realized. Their central bank digital currency is in the hands of over 250 million Chinese. Within 10 years, we could see their currency or the architecture of their currency in a third of the world's, the population of a third of the world. And so it really is urgent. And our call for urgency has finally been reflected in the Biden administration's executive order calling for the United States to take an urgent approach to development of central bank digital currency. And that's why when I left the CFTC, I launched something called the Digital Dollar Project to advance exploration of a U.S. central bank digital currency. And last fall, we announced 9 pilot areas that we wish to examine, everything from retail use of a digital dollar to wholesale use. And putting our money and our time where our mouth is, in April, we announced the launch of the first of those pilot projects, the first ever in the history of the dollar, examining the use of a digital U.S. dollar, but even more importantly, the first examination anywhere in the world of central bank digital currency conducted entirely by the private sector, not initiated by a central bank. And that's really important because our founding principle is that money is as much a social construct as it is a government construct. And in fact, as I say in my book, Crypto Dad, The Fight for the Future of Money, money's too important actually to be left in the hands of central bankers. The private sector, society at large, especially in a free society, must voice their imprint on the values that are encoded in digital money.
It's interesting because prior to coming on stage here, we were talking about that we think in such a US-centric fashion, not realizing that billions of people around the world didn't have legacy infrastructure. They are, in fact, light years ahead of us. This is how they transact cross-border payments. They're building businesses around this. So even when we think about infrastructure like trains and our banking systems, they're almost ahead of us in certain respects, and we can't fall behind. And one thing you had taught me earlier, I did not know this, the CFTC was born to foster innovation within the securities and financial banking space. So this week, with regulation introduced that the CFTC will start to oversee cryptocurrencies, to me, that's exciting. To me, that means that regulation framework might happen quicker. What are your thoughts around that?
Jill, I'm so glad you asked me that question because a lot of people now, in the 24 hours, 48 hours since the introduction of the Gillibrand Loomis bill, are saying, wow, it's surprising that all this authority is being given to the CFTC. Well, in fact, there's a lot of historical precedent for the CFTC being assigned asset classes. People forget the CFTC was formed following the creation of arguably the most important financial innovation of the 20th century, and that was the creation of the financial future. The financial future allowed the world to go off the gold standard and onto a dollar standard. That was very important for the United States in the 1970s. And Congress and the White House then were very afraid that if this was given to the SEC, they would stifle the innovation. So they took a bureau out of the Department of Agriculture, they named it the CFTC, and they gave it authority for financial futures, and they wrote into the CFTC's charter a mandate for innovation. So there's a lot of precedent for a new asset class being given to the CFTC with a mandate to allow for innovation and not to stifle innovation. So I find nothing unusual that the Lummis-Gillibrand proposal proposes the CFTC to govern the innovation of this new financial asset class.
I mean, I have tons of questions. I just have one, if I can just interject here a little bit. So what's interesting to me is you mentioned gold standard and CBDC and the digital dollar. Help me understand, or help the audience understand, on what basis will this be staked on, so to speak? How does the
digital dollar?
A digital dollar.
So there's, first of all, a digital dollar is a broad generic term. There are many different designs for how a digital dollar could evolve. And we need to examine all of the logical ones. But one way would be a digital bearer instrument. Unlike a stable coin, which is stabilized by reference to a national currency, this would be a national currency. This would be a dollar. It would be no different than the dollar that's in your pocket. It would rely on a series of algorithms and the World Wide Web through hosted intermediaries confirming its value proposition. So when you go into a shop today to buy a sandwich and you give them a $20 bill, nobody needs to know where you bank, how much money is in your bank, what's your social security number. All they need to do is examine that $10 bill to know that it's real. It's the token itself, verification of the token itself, that gives fiat money its power. That's 10% of the money we use. Everything else is based upon a liability on some bank or financial institution's balance sheet. And in order to transact in everything else, including Zelle and Venmo, you've got to go back to that institution and confirm this person is recognized, they've got an account, they've got so much in their account, et cetera, et cetera. That's why that system is so expensive. A digital dollar would be a digital bearer instrument. It would be no different than the $10 bill in your pocket. You go to a shop, you'd still use the same readers that you do for a Apple Pay or a Zelle transaction, but this time real money would transfer, real value would move from your digital wallet to their digital wallet without going through all these financial institutions. For small businesses, think about what that would mean in terms of the velocity of money. They'd have money immediately in their till rather than waiting 30 days and paying 2 or 3% to a credit card company. For remittances, the ability to send money around the world the same speed that you send a text message without waiting 3 or 4 days, 7 days, paying 17% in some cases to send money around the world. There's so many uses for a digital bearer instrument. Positive, there are also a lot of challenges as well. That's why we need to experiment with digital money today so we can make a decision later on whether to deploy it or not.
So when we speak about regulation, of course, a big question is spot Bitcoin ETF. It's important for retail investors. It's a way to help them understand the mechanics of this in that neat little wrapper.
Right. With
the CFTC, I mean, we know they're approved. They're approved in Canada and in other areas of the world. We have our futures ETFs, but a core spot, whether it's Bitcoin, ETH ETF, does that happen at a faster speed at the CFTC, if you will?
Right. So I think it does. So the SEC, under our jurisdiction, has authority over ETFs. And so far, it has only licensed ETFs based upon the CFTC's futures market. The CFTC, under our current jurisdiction, doesn't have authority over spot markets. If the CFTC were given authority over spot crypto markets, as is proposed in the Lummis-Gillibrand bill, that may allow the SEC, therefore, to once again say, well, if the underlying market is governed by the CFTC, we can get comfortable with an ETF. So I'm hopeful that the Gillibrand Lummis bill may actually further us down the road toward a spot Bitcoin ETF.
Is there, I'd say bipartisan, for lack of a better term, to get the ball rolling when it comes to digital assets and get, I feel like it can also become a politicized issue, and that could potentially stifle it, especially when you talk about like the bad things that can happen with crypto.
It will be a political issue because that's what we do in democracies. We politicize everything. But, the political process can both be a hindrance but can also further it. If we could get bipartisan support, that means, unlike, say, Dodd-Frank, which was largely the work of one party, if we could get bipartisan work, that means both parties are committed to seeing it work. And that's one of the things I find so promising about the Lummis-Gillibrand, Lummis Republican, Gillibrand Democrat legislation. It's starting off on a bipartisan footing. That's very important. So I'm very optimistic. that not in this Congress, but in the next Congress, I think we could see movement on this. You know, crypto, people are realizing that crypto is more than just some funky new asset class. Crypto is much more important than that. Crypto is a new architecture of value. You know, for the last 400 years, since the Dutch Bank of Amsterdam first allowed people to put their guilders on deposit and issued them banknotes, the financial system has been a series of obligations of financial institutions. What crypto is really about is using the web of computers and proper protocols to look to the internet to confirm value rather than your money is safe with this bank. Well, we found over time that sometimes your money's not safe with that bank. But the internet has never gone down in 30 years, okay? If we could come up with the right protocols of value, it's revolutionary for money. So I think it's not in the interest of the crypto industry to constantly look at this as some new investment asset class. We've got to look at this as really much bigger than that. It is really a new architecture of value, a new architecture of money, a new architecture of the confirmation of the ownership and transfer of value. And in that light, it's as big as Bluetooth, it's as big as 5G, it's as big as TCP/IP. All the protocols that guide the internet today, these, you know, what Bitcoin is, what Ethereum is, what Solana is, are new protocols of guiding the interest of money in the future.
So, Jill, I have a question for you.
Of course.
NASDAQ and markets, and you know what's going on. So what we've just heard from Chris, right? Does this mean Mastercard, Visa, PayPal, Zelle, are they worried about their business model?
Right. We were talking about that before. You know, when you think about the Web 2 to Web 3, it's not like Web 2 is just going to let these opportunities go away, and we're figuring out how to bridge that gap. I think when we hear at fintech conferences or fintech companies that come on the show, that the narrative is very different than when I first started covering this about 4 to 5 years ago. It's not so much us versus them anymore. It is marrying the speed of technology with the scale of legacy institutions. And we're starting to hear more of that in the crypto space as well. And I think the industry needs to do a better job when it comes to telling that story and educating investors and educating regulators and the average person. You know, I think even with the underlying technologies, it's always been associated with coins, right? And to be able to explain how all these different technologies can be applied. I mean, you know the power of blockchain and what it can be used for. You know, even to something as simple as smart contracts. You know, when you're doing title, when you're doing your mortgage, when you're doing, you know, insurance. InsurTech is another industry that's ready for insurance for disruption. So I think we're telling the story better, we're helping people understand, we're marrying technology and scale, and I think that's a good thing. And it always comes back to educating the industry, the investors, and regulators.
Jill is absolutely right on this, and I will tell you that the PayPals, the Visas, and the Mastercards of this world are some of the most engaged industries in examining central bank digital currency. They still have a value proposition in the future of money. If we get central bank digital currency right, it's the underlying rails upon which the private sector builds the railroads, right? There's still a need for 30 days credit that credit card companies provide. There's still the need for purchase price protection that they provide. They have an important role to play. Just because we may digitize central bank digital money, just because we may develop stablecoins, there's still need for payment services that they provide. And they've been some of the most forward-leaning examiners of this new innovation that I'm aware of.
Yeah, I mean, PayPal CEO is here. Visa's head of blockchain, I believe, is here. I mean, all the payment companies are here.
Yes. They're not afraid. They're seeing this as an opportunity.
Yeah, so we're hoping that they buy some of the flagging companies that are existing there in the startup world with this crash in the market. So we're hoping that happens.
Well, I mean, the whole thing is, you know, when we're talking about when do we start dipping our toes back in the market with stocks that are their valuations have been reset. If we're thinking that way as an individual investor, you don't think that these, you know, these companies flush with cash, like in Apple, for example, and Microsoft, for example, aren't thinking about valuations either. And we know it is more efficient to buy the technology, buy the workforce, buy the skills versus developing it organically when the technology already exists. So if we're thinking about valuations and what looks attractive, they certainly are.
Yeah. Yeah. This reminds me a lot of the year 2000. I was a lawyer in private practice representing a lot of dot-com companies, some of which crashed and burned. But, you know, out of that came Google, came Facebook, came Netflix. Some of the giants of internet commerce rose out of that crisis. The lesser business models crashed and burned. The better ones emerged. And I think you'll see the same thing now.
We're at your 3:30. We're on time.
Yes.
Do you want to close with a couple of words, or?
I tell you what, if I'm probably toward the end of my public life. If I'm just coming into financial markets, right? If I'm coming into technology now, this could be one of the most exciting times to enter this industry there's ever been. I think that what we're seeing right now in the time of the market is a time to lean in, not lean away, because the best opportunities are going to come out of this uncertainty right now.
Love it. Lean in, don't lean away.
Yes, love it. Thank you so much.
Thanks.
All right, thank you so much. Pleasure.
Thank you so much.